Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about GR Lifestyle Company Limited annual report. GR Lifestyle Company Limited offers a diverse range of businesses and services through its two main segments, property management and property development and investment. In the property management segment, the company provides various services including property management for office buildings, residential properties, and car parks. This includes heat supply and maintenance services for heat exchange stations and pipeline networks. In addition to these services, GR Lifestyle Company Limited also offers general management services such as repair and maintenance of buildings and fire safety equipment. These services cater to both residential and commercial property projects. The company's expertise extends to managing vacant properties, ensuring that they are well maintained and secure until they can be reoccupied or sold. Through its property development and investment segment, GR Lifestyle Company Limited engages in the development and investment of properties across various locations, including the United Kingdom, the United States, and the People's Republic of China. The company's extensive experience and expertise enable it to provide a comprehensive range of services that cater to the diverse needs of property owners and developers. Overall, GR Lifestyle Company Limited is a multifaceted business entity that offers a wide array of services and businesses related to property management and development. Its commitment to providing high-quality services has enabled it to establish itself as a reputable player in the industry. The GR Lifestyle Company Limited market capitalization of $9 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that GR Lifestyle Company Limited holds a significant advantage in their industry. GR Lifestyle Company Limited trades at a higher price-to-book ratio of 8.44 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 61% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth and decline are multifaceted and influenced by various factors. On the growth side, the company has experienced a significant increase in revenue from property management services, with a notable 10.6% rise in this segment. Additionally, the introduction of new revenue streams through restaurant operations has contributed to overall growth. Rental income from operating leases has also been a key contributor. On the other hand, the primary drivers of revenue decline are more limited in scope. A decrease in capital expenditure and fair value loss of investment properties have both had a negative impact on revenue. These factors highlight the importance of prudent financial management and strategic decision-making in maintaining revenue stability. The analysis of the company's financial performance reveals a concerning trend. Despite multiple assessments, the consensus is clear. The company is struggling to generate positive operating cash flow. On page 4, the initial review was inconclusive, but subsequent evaluations on pages 10, 11, and 19 all confirm that the company is experiencing negative operating cash flow. This consistent finding suggests a persistent issue with the company's ability to generate sufficient cash from its core operations. The company's financial health has undergone significant changes over the past year. A notable shift is observed in its debt level, which has seen a substantial increase from HK $744,707 to HK $1,839,400,000 $484,000. This represents an approximate rise of $133,998,000. Furthermore, interest expenses have also witnessed a considerable hike, with finance costs increasing by approximately $28,571,000. These changes indicate a significant alteration in the company's financial standing, warranting closer examination to understand their implications on the business's overall performance and future prospects. The company's financial performance varied across different segments and regions. In terms of segments, the property management segment stood out as a strong performer, with revenue increasing by $17 million from $169,816,000 to $186,936,000. This growth suggests that the company is effectively managing its properties and generating significant revenue. On the other hand, the property development and investment segment had stable revenue, indicating a steady but not spectacular performance. The lack of significant growth in this segment may be due to various factors such as market conditions or competition. Looking at the regional performance, the USA region was a standout performer in the property development and investment segment, with high occupancy rates in both commercial and residential areas. This suggests that the company's properties in the USA are highly sought after and generating significant revenue. Unfortunately, there is limited information available on the UK region, as no performance metrics were provided. Similarly, the Chinese mainland, PRC, region has some data gaps, with no specific performance metrics provided for the property management segment. However, it is worth noting that this region is mentioned separately in the report, suggesting that it may be an important market for the company. The company is taking a proactive approach to growth by expanding its operations through strategic acquisitions. This move indicates that management is confident in the company's ability to integrate new assets and capitalize on emerging opportunities, positioning the organization for long-term success. By acquiring complementary businesses, the company aims to enhance its market presence, increase revenue streams, and drive innovation. There is no notable activity in terms of acquisitions or divestitures. The company has not made any significant purchases or sales of assets, businesses, or subsidiaries that would impact its overall operations and financials. This lack of activity suggests a stable and focused approach to business management, with resources being allocated towards core objectives rather than external expansion or restructuring efforts. That concludes the financial summary for GR Lifestyle Company Limited. Feel free to comment below, and I will be happy to answer them when possible.